Well, hello and welcome everyone. I'm Danny Roberts, Coordinator for Regional and AgTech here at LaunchVic. Thank you for taking the time to join us online today. I'd like to start by acknowledging the traditional owners of the land upon which we're all beaming in from. I acknowledge the Taungurung people, who are the traditional owners from where I'm coming to you from in northeast Victoria. So please just take a moment to think about where you're joining us from as we pay our respects to elders past, present and emerging. Our session today is focused on the areas of banking, accounting, tax and insurance. These are some of the most important things that you need to get right from the start when you're starting a startup. Although a good idea is fantastic, but it doesn't stand up when you don't get these things right. To guide us on our learning journey, we're joined by Michael Nusafuro, founder of Thriday, and Matt Armand, founder of Upshore, who will be taking us through today's content. We're a small group, so please feel free to ask questions throughout by using the raise your hand function at the bottom of your screen. Or if you feel more comfortable, feel free to pop them in the chat and we'll come to them when we have a moment. So with that, I'd like to hand over to Michael and Matt. Thanks so much for being here today. And over to you, Michael.
Thank you. Thanks for having me. I'm going to be going through banking, payments, a little bit about sort of financial management and why it's important for your business. And then Matt's going to be running the second half and talking through insurance. And Matt's one of the leading experts on that, so I'm looking forward to hearing that. I'm just going to share my screen and just quick introduction. Firstly, I am the co-founder and CEO of Thriday. And what Thriday does is we try to help small businesses manage their finances seamlessly. I've been involved in startups for a little while, and prior to that, I worked in banking for many years. And I've been involved with LaunchVic over the last few years. Initially, Thriday went through the 30 for 30 program. And then I've been doing a little bit of sort of advisory and coaching and supporting some of the teams that are in and around the LaunchVic ecosystem. For today, I'm actually going to be running you through some really important things which will help make your lives a lot easier when it comes to tax time, running your business, looking at investment, managing your cash flow. And the topics will include everything from banking to payments, tax deductions, tax lodgement, and then ultimately sort of thinking about the right setup and software for your business and the stage you're at. The good thing to note as I go through is that some things are hard to change later and some things are easy. I'll try to call those out as we go, just so you can hopefully think about those things up front when you're making decisions about your financial admin approach. There is a lot to running a business from a financial perspective. And I would dare say most business owners, if you were to look at sort of their traits and characteristics, the financial part is often not a strength. There's a desire to make money or be successful, but the actual grind of like making sure that financially your forecasts are accurate and you're not going to be left in any awkward positions, or that you're lodging and claiming the right tax deduction is usually not a strong suit for most founders, and they usually outsource that, right? So you'll usually have bookkeepers and an accountant. Now, whilst that's all good, I think it is really important that as a founder, you are able to understand your numbers. And I don't think it's any coincidence that a lot of successful businesses have accountants as a founder, because I think that strong financial acumen is there from day one. And that's everything from how you think about fundraising to maybe getting debt to how you fund the people that you hire and do that in a sort of relatively frugal way for the stages you're at, and all of those different components. But what I'm going to run you through is, there's the banking part. And I know most of you may think of banking as a commodity, like most banks all offer the same thing, and to some extent they do, but some are more friendly towards early stage businesses, and some do have more features and tools that are useful for you. So I'll run you through that. Then I'm going to talk you through a little bit about accounting and how that can be applied to help you make smart business decisions. And then tax, which is obviously the compliance bit and making sure that you're reporting things, but ultimately also maximizing any deductions and things that you can. And there's also some things as an early stage startup that can give you some tax breaks, your R&D, all of those different things as well. The first thing I wanted to run through is around actually the bank account part. And it's important at the beginning that firstly, you separate out your personal expenses from any business expenses. So depending on the stage you're at, usually in the very early days, you might not even have an ABN registered. You might not have a company formed, but you may already be spending money. You might have purchased a domain, you might have purchased a logo, you might have started doing some research and so on. And at that early stage, it's always best to set up a separate account so that you can track the spend on that versus your personal expenses. And it's important to note that most banks don't mandate that you provide an ABN to open a business account. So if you're applying at that stage for what would be called a sole trader account, the bank will only be doing a verification on you and not necessarily requiring you to provide an ABN. So there's an opportunity to do that. And then once you form the company or get your ABN, to contact the bank and add it to that account. The other thing I encourage in the early stage is a model that I'm really, really passionate about and something I share with all businesses and startups, which is called profit first. What profit first is, it actually sort of flips around the traditional model of how you receive money and spend money. And what it does is a very specific model, which says you should have 5 bank accounts. The first account is for revenue. And that, just to be clear, they should all be separate, right? The whole point of this is you're separating out money for different purposes. So what it says is you have a revenue account, and when revenue comes in, you define a set percentage of that money that you want to distribute to these 4 other accounts, which is profit, tax, owner's pay, and operating expenses. And what this does is at the early stages, it's already training you to have a budget. These percentages should be based on some sort of forecast or analysis you've done. And it's forcing you to set money aside for profit and yourself, the owner's pay. So you might, at the early days, say, I'm only going to take $100 a week, right? Because you're not earning much. So you might say, I'm going to aim for 5%. But at the very least, you're starting to think about your earnings and how you want to distribute it. And it's forcing you to make those decisions. And what I like about it is most people start a business and never turn a profit. Most people start a business and don't pay themselves for a long time as well. So all their income essentially goes to tax and operating expenses. But doing it this way forces you to think about this upfront. And there's a whole book that's been written about this model. It's very, very popular in the US and is becoming popular in Australia. And I think it's a fantastic model because of the reasons I mentioned. You're planning, you're organizing, you're separating, and then you're forcing yourself to put some money aside for profit and yourself. Now, when you're opening a bank account, there's a number of different things you have to consider. Most people will obviously nowadays look for a bank account that they can seamlessly open online. And in that sense, not all banks are created equal. Most of the major banks have pretty seamless digital bank account opening processes. They can get a little bit more complex when you have multiple directors in a company. And in some cases, even like Australia's, I guess, my biggest bank, Combank, typically requires you to go into a branch. That can be fine if there is a branch nearby. And, for some people, you might have business partners in other parts of Australia or living remotely. So that is a consideration. When you're looking at the newer fintechs, they tend to allow full digital onboarding, so you don't need to go into a branch and sign anything. So just keep that in mind. Fees and charges is a big one, and they can creep up. There are banks where if you, for example, are sending a lot of money overseas or paying for goods, products and services overseas, that you get lumped with an additional charge for international transactions. And if you're spending, for example, let's say you've got a lot of money going to a software that you're using in the US, let's say it's $500 a month, you're probably going to be charged, $5 to $10 a month just for that privilege on top of the 500 that you're paying. And if you do that over like 5 or 10 pieces of software, all of a sudden you're spending $100, $150 a month on those fees. I've had that experience myself. So in that situation, you can definitely look for accounts or banks that have low or no fees. Again, there's also fintechs that you can look at, like Air Wallets, which allows you to open accounts or cards in that particular region. So you would open a US account, so that essentially you're just paying locally. You're paying between your US account and the US software company, and that can be a huge cost saver. It's 2024, so obviously most people do their banking online. So the quality of the applications is important. I know for retail customers that Up is really popular. I know for companies, Combank and NAB have pretty good offerings, which allow you to send significant amounts of money. You can have extra security functionality. So again, it depends on your business. If you're expecting to be processing hundreds of thousands of dollars in a day, so for example, you might have payroll and you might have 20 staff, you need to have a bank account that allows you to transfer that amount of money in a day, and not all do. So just keep that in mind. Interest, again, usually in the early days, it's not a big thing because you don't have a lot of savings where you can generate interest on. But again, as you grow and or if you raise money, interest can be actually a significant earner for you. So I'll give you an example. If you raise $1 million and currently you can get, say, 3 or 4% interest rate on that, that's a healthy amount of money you can make just on having money saved in an account. So I'd rather have that money if I was a business than not. So do avoid having interest-free accounts if you do have savings set aside. And then I think the final thing that most people get tripped up with is payments. So they run a business where they need to accept payments, whether that's in person or online. And again, not all banks are created equal, so it's important to check what they offer and support. And also, if you don't want to get that service directly from a bank, again, there's a number of fintechs like your Zellers, Square or Block, Stripe, for example. And again, it just depends on whether you expect to receive money in person or online and how much. And you can, again, look at the rates and functionality for all those types of services. But fundamentally, upfront, it's important you think about how you're going to receive money and pay for things. And you don't want to be in a position where you need to go and pay for something and your bank doesn't allow you to pay that amount, or you have certain limits that are just not conducive to the type of business you're running. Let's talk about payments a little bit more, because often this is an area where I see people make mistakes, and then this is a big one where to unpack it and change it can be quite complicated and expensive. So what often happens is when people are starting a business, they'll pick a payment solution, and let's say they pick Stripe. So Stripe's got a lot of buzz, very successful startup. They hear about it and they sign up for it. They then realize that they need to accept payments in person. And then they have to sign up for a product like Tyro or Zella, which has a physical terminal or some sort of way to accept payments on your phone. And then they may determine that they need to direct debit customers. So let's say, for example, you run a gym. You want to be able to accept payments in person for people that are coming in and paying by session. But then you also have customers that are paying on a monthly ongoing basis. So you want to direct debit their account. Then all of a sudden you need potentially need a third solution. So up front, it's important to map out the ways that you expect to be charging customers and trying to pick a solution, even if you're not using that solution up front for all three, but try to pick a solution that can support all three, so that you don't have to pay for three different services and have three different things that you have to try to get to talk to each other. But it'll also just save you hassle and time and all of those things later. So just keep that in mind. Also important to think about if you're going to be receiving a lot of money internationally. And again, there's a lot of cost involved, sort of hidden fees and charges here. So if you're going to be paying staff or suppliers overseas, it's best not to just use your standard bank account for that. The banks make a lot of money off that, right? So you go, I've got to send money overseas. Most of the banks offer an international remittance service, but they don't give you the best rates because they know that you're a customer of theirs and you're sort of paying for the convenience. But if you set up something separate with, say, Wise, Airwallex, and there's a variety of different other solutions out there, just look out for the best rates, and I guess look for the money flows that you expect to occur. So you can specifically look at the rates for the countries that you expect to be sending and receiving money in to make sure that you're getting the best rate. And again, as your business grows, you can be saving hundreds, if not thousands of dollars on that. Personally, I ran my first business, processed payments for parking. And we were processing about $1 million a month in the end, parking payments. And changing payment providers ended up saving thousands of dollars for us a month because it was literally a percentage. Like they were taking the original service we were using was, say, 1.7, and we managed to find another solution and negotiate that down to like 1.2. So 0.5% on every transaction was huge. So, keep an eye out, keep on top of it. And again, try to pick the solution up front because it can be tricky later to unpack all of that. When you're looking at payments as well, you want to make sure that it's easy to use. Ideally, it's embedded. So like when it comes to terminals, I know some of you run AgTech businesses, so you might need to go out to remote areas and farms. You need to make sure that that way of making payment works. It doesn't have backup. If reception's not good, does it still process it offline? I was at a restaurant recently where the payment terminals were down and I couldn't pay, and they were asking people to go to an ATM to withdraw money. I didn't have my card on me. So all of those types of things can occur, and they will occur at some point. So you want to be just double check and make sure that what you're picking, definitely some terminals have backup capabilities. Some of them have their own SIM card so that if internet's not available, they can connect still, etc., etc. All right, now I want to sort of change from banking payments into tax, and link to that first thing I said about banking and having sort of separate accounts and all of that. The other benefit of that is you can easily track your expenses and therefore what you can claim as a tax deduction. I'm sure you all know this, but it is really important to keep receipts of all your expenses. And you can use software, or you can obviously use your bookkeeper accountant to help guide you onto which of those expenses can be claimed as a deduction. In most cases, most business expenses can. So it's relatively straightforward. And in that vein as well, it's important to keep a record of your assets and liabilities. In most cases, as an early stage business, you'll only have maybe purchased some assets, whether that's a phone or a laptop. Again, all of those things can be claimed. And what you're trying to do here is you're not earning, in most cases, you're not going to be making a lot of money or be profitable early on. So you're just trying to claim as much of a deduction as you can. And even in future years, that can pay off significantly. So I'll give you an example. Your first 2 years, you might not be making any money. You might be running at a loss because you've raised some money or you've invested some of your own money into the business. But making sure you maximize those deductions means that when you do start to become profitable, that obviously that gets traded off, reconciled for future years. So the year that you are profitable, the ATO looks at your prior losses and says, well, all in all, you haven't made a profit this year because we've included the deductions or the losses from prior years. So that's really helpful the first year you got to make a profit because you're not going to get taxed unnecessarily. And essentially in that first year of profitability, in most cases, most profit that you've made, you get to keep in your pocket because you've incurred some losses in prior years. It's also important to note that increasingly the ATO does have more sophisticated systems for looking at anomalies, flagging things that may not be accurate and doing audits. So for the simple effort of keeping a receipt, and there is, again, a lot of software you can use for this where you just take a photo or scan it or whatever, it's not worth it. So I'll just get into the habit of doing it from day one. The other thing to note here is if you're registered for GST, so if you're expected to earn over 75,000, you'll need to register for GST. And what that means is that on your pricing and invoices, you'll need to include GST. And this is an area, again, I see some startups get wrong. So they price their product in the early days because they're not earning much money, not thinking about GST, and it's 10%, right? So if you're expected to charge $30 a month for a product, then all of a sudden you don't change your price, but you have to factor in GST. You're going to be getting $27 of that $30. So just definitely keep that in mind. And I think for most startups, it's just recommended that you register for GST pretty much straight away because it also allows you to then net off any GST that you're paying suppliers for as well. I thought I'd just put this in here quickly as well because a lot of people have a bit of confusion around the dates when things are due and things like that. For most businesses, you'll be doing your BAS quarterly, so every 3 months. If you're earning, I think the threshold is 25 million and above, which hopefully some of you get to, that's when you have to do it monthly. And then if you're a relatively small business, you can do it annually. But the quarterly one is usually what most businesses are on. And the quarters run based on the financial year. So you'll be the amounts that you're calculating are say from Jan to March, and then you have about 6 to 8 weeks to lodge your BAS after the month ends. So under the months there, you can see when your BAS will be due, which is the 25th of August, for example, for Q4. And then you can see for a company, you actually have all the way to the 15th of May to lodge your tax. So that's essentially 10 months, 10, 11 months after the end of the financial year to lodge your tax. And the thing to consider there is in most cases, if you're expecting a tax refund, so you've calculated that you've paid more tax, you'll want to lodge your tax return as soon as possible so you can get that refund for cash flow. On the other hand, if you owe money, you'll probably want to try to hold off and lodge your company tax return as late as you can. And then the final thing before I head over to Matt is just a quick overview of accounting software. Now, all of this can be managed easily or relatively easily using these different tools. Xero is by far the most recognised, but there are other good services out there. I know even Mild has been launching some improvements. QuickBooks can be popular with certain customers. In most cases, it all depends on your financial acumen and how confident you are with the numbers. If you have a relatively simple business, it's best to use a tool that's cost effective and not too complicated. If you've got a more sophisticated business where you might be dealing with multi-currency, you might have multiple entities, you might need to give access to staff to do things, you have payrolls to run, then you would be looking at a more fulsome product like your Xeros, Miles, and QuickBooks. But there is a lot of emerging technology in this space. That's just something to keep an eye on. And I think, as always, same with banking, same with accounting, and payments, you have to sort of establish what your requirements are and what your needs are, and then obviously pick the best solution for your requirements. That was it from me. I don't know if there was any questions. Do you want me to take some, Danny?
I was just going to say, Dan has a question about R&D and tax credits. If Dan, would you like to maybe come off mute and open up your camera if you can and have a chat to Michael?
Yeah, thanks very much, Danny. I'm on a computer without a camera, but thank you, Michael, for presentation so far. I would have thought many of us on the call are at a stage in the startup where we're actively developing products and perhaps technologies. It seems to me that the R&D tax credit would be relevant, and I'm just wondering, is the R&D tax credit, assuming an organisation is eligible for it, something that provides cash back to the organisation, or would it only be offset against future profits?
Good question. The first part to unpack is you do need to be GST registered firstly. So that is an important one if you're expecting to make a claim. The second thing, and I'll build up through the questions and the answers. So the second one you want to do is throughout the year, you want to record the time that you're spending. You can use simple trackers, or if some of you are using software solutions like ADO or work tracking software, as your team builds and develops things, you should definitely keep a record of all of that, because I've lodged a few of these, and you'll need to have all of that evidence if the auditors ever come. But what you're looking there for is there are expert R&D advisors. Usually there's a lot of them that do it under their own company and brand, or there's also your more boutique and even all the way through to your PwCs and stuff can provide you some guidance. I would always have an upfront conversation with a few of them, firstly to pick the one that you think you want to work with. And what you're looking for there is for them to guide you, understand the technicalities of your product, what you're doing in the business, and what's novel and what's not novel, because it legitimately has to be novel. It can't just be you're building something that every other business has done. And then through that guidance, you will then track the work related to the specific novel elements of what you're building. And then that forms what you make a claim for, and it's at the end of the financial year. So what you do is you've worked on that. Let's say you've spent $100,000 worth of time and effort in that financial year working on that particular novel component. You would then make a claim for that 100,000, and they will give you up to 45% of it back. So you're not going to get the full 100,000. You'll get 45% of the 100,000 that you claimed that you spent working on that novel component. So you will have to wait for that to come. Now, usually if you lodge everything relatively early, you'll get that money back within sort of 6 to 8 weeks. So let's say you lodge it literally on July the 1st, you probably get it towards the end of August. And in that example, you'll get $45,000 back as cash directly to your bank account. And unless they are wary or the information you provided looks a bit sus, there won't necessarily be any questions asked. So they'll just review. There's a series of documents and things you have to provide, and then the money will just be released. Now, I have heard of some startups over-egging what they're doing, and like anything, you can do it. There's a risk that you'll get a knock on the door to audit it. But yeah, that's pretty simply how it works. The only other thing to note there is I'm not encouraging this in any way, but there are companies that provide debt against your projected R&D claim. So they will look at you, again, what you're doing, what you're claiming to be novel, and if they think that there's a legitimate claim that's going to be made, they will say, okay, you're expecting to get $45,000 back in August. We'll give you the $45,000 now as debt. And then obviously as it gets paid out, you'll have to pay that back to that organization. So that is something that some startups do for cash flow purposes. So what they essentially do is at the end of each month, throughout the whole financial year, they're telling one of these lenders, hey, this month I spent $100,000 on R&D. Can you give me 45,000? And it's just obviously helping with cash flow. So they're not waiting till the end of the year to get it all at once. Obviously, the trade-off is you are having a debt on the books, and there is a risk that you can't pay it back later or something else emerges. So it's not something I'm encouraging, but I know that startups that have fairly stable cash flows and income, they may want to leverage that as a way to just, not run. I guess, obviously, most startups are burning a little bit each month or a large amount each month. So that type of opportunity to use an R&D, I guess a debt against the R&D claim, can be useful in those instances.
Michael, thanks so much. That's awesome information. And so when you said the 45% comes back, I guess I interpreted that as it comes back from the ATO regardless of whether you made a profit or not in that financial year that
Yes.
you're assessing.
Yeah.
Perfect.
So
awesome.
My particular business has been running at a loss for the 3 years it's existed. And we have claimed there's novel components we have built. Every year we have received that cash in the bank account at the end of the year. Yeah.
Yeah, super helpful. Thanks so much.
It's all right. I want to leave some time for Matt. Any other questions? Okay.
Might be all clear.
I've just got it. There we go. Stop sharing.
Beautiful, beautiful. Thanks, Michael. And look, as friends, partners, and clients of Friday, they have an amazing business and product. So, highly recommend checking it out. Yeah, cool. So, my name is Matt Armand, CEO and founder of Upshore. We are in essence, we're an insurance broker, but we're pretty specialized. We mainly deal with innovative companies. Try and stay away from the cafes, the restaurants, the architects, and the traditional kind of suburban broker type clients, and really focus on clients who are doing something a little bit different or are in some kind of tech space. For all my sins, I've been in insurance for about 22 years, and my business partner comes from more of a hardware and product development background. And I think his frustrations with buying insurance and my frustrations with dealing with traditional clients was kind of the reasoning of Upshore kind of coming together. And we've been going for 4 years now. So established 2022, about 250 clients. We're a pretty small bespoke team of 5, but look after some pretty exciting clients around Australia. So a lot of fintech, a lot of SaaS, a lot of clean tech, AgTech, green tech, hardware, anything with tech in the name, pretty much is kind of our bread and butter. And we have a really good understanding around kind of asset requirements or CDR requirements in kind of Michael's space, and what needs to be done to kind of get the right insurance in place. It's going to protect you should you hopefully not ever need it. This is a real rundown of kind of, what we kind of do, as a broker. We have access to, all the Australian insurance companies, 124 underwriting agencies in Australia, and in the Lloyd's of London, 76 syndicates. So we build a lot of insurance programs bespokely. We don't just plug it into a system and try and get a quote that's closest to what you're doing and hope that, in the event that something goes awry, that the claims people are going to pay it out. We're founders as well. I think this is a big one. So we try and be, we're pretty founder friendly. We've raised some capital. We're building out a team. We're building out product. We're probably the least pushy kind of, insurance people that you'll meet. It's more about just kind of, helping out and being part of that journey, I guess, as businesses scale, offering you the types of insurance we think you need on your journey. So, yeah, it's a bit of a rundown here, which I can share afterwards, and you'll be able to kind of look at in your own time. Now, the types of insurance best suited for AgTech startups, I've thrown 6 on here. There may be more, there may be less, depending on the business and the stage that you're in. But the main ones we kind of see is that professional indemnity, cyber insurance, management liability, general liability, also known as public and products liability, or broad form or combined liability, your business insurance, and then intellectual property. So it's not going to be a death by PowerPoint by any means, but it just kind of shows, some of the high level rundowns on some of those insurances, why we recommend you have them, and also, what could go wrong, and how it could help if things do go wrong. So this is something that we get asked a fair bit, and it is quite confusing. Insurance is a minefield, and it's full of jargon, and it's full of, kind of old people in double-breasted suits doing deals in pubs. So we're trying to bring that to the kind of new age a little bit more. So professional indemnity and general liability always kind of get confused, and so this is just a bit of a rundown. I kind of see it as, professional indemnity is more for a lot of those white collar type roles. And then general liability, very broadly, is when you've got a product or a service or a physical location or product. So this one gives a pretty straightforward rundown. So professional indemnity, it's if you make a mistake in the service or product you provide. So an example for this is your AgTech startup develops a software that gives farmers advice on when to water their crops. The software gives wrong advice, or it makes a mistake, or it doesn't. There's some bad coding inside the unit. Farmer might sue you if you kill 100 acres worth of crops. PI insurance will be there to defend your claim and to kind of pay it out. Liability insurance, on the other hand, is if you've got something that could injure someone or damage property. So it's not a financial loss, it's more someone's injured or property is damaged. So this could be any physical product, could be an IoT device that, explodes. It could be, you having people on your premises injuring themselves. This covers for, the losses, the costs to kind of get someone or the property back to the state it was before the claim. Very high level. PI insurance is like a safety net for when your professional advice, service, or technology doesn't work as expected and causes a financial loss. Liability is a safety net for accidents that cause physical harm. Look, generally, there might be a bit of crossover, and you'd need a bit of both. For businesses like, Thriday, when you've got an online platform, the chances of that injuring someone or damaging property is pretty minimal, but someone could always, trip over Michael's briefcase in a meeting room and, put a claim under his liability policy, but very minimal exposure. And it's always a bit of a case-by-case basis. Cyber insurance is, pretty touchy subject these days. It's, this is a big medical kind of cyber outbreak recently. A lot of the big insurers overseas are saying, if not, it's not if, but when, something's going to happen. And, it's pretty, we see some of the dark web chat rooms of these cyber groups actually employing teams to kind of build businesses to set up cyber attacks, and it's like they're building a fintech business. They want head of architecture, they want salespeople, they want recruitment, they've got managers, and it's people in boardrooms, kind of on laptops. It's not people in hoodies in basements these days. It's professionally run organizations, which is pretty tricky. So I've put in here some of the main kind of exposures we're seeing at the moment. So data breaches, ransomware attacks, system failures, intellectual property theft is a big one with ransoms on the back of it to kind of get your IP back, and phishing and social engineering. The social engineering one is fairly prevalent at the moment. This is threat actors pretending to be someone else, either by email or infiltrating your system. We've had claims where third parties have gotten into systems, not really done much, but kind of just sat there reading emails and checking calendars and watching what goes on behind the scenes, waiting for one of the executives to go on holidays, and then sending an email to the CFO pretending to be the CEO, going, Gavin, as you know, I'm in Greece at the moment. I forgot to fix this invoice up. Make sure it's paid today. And they'll use the exact tone that the workers have had in the past. And yeah, very, very clever and pretty scary.
Matt,
Another yes,
just before you move on,
sure.
Danny's got a question in the chat there. His
Oh, of
co-founder
course.
needs to drive their own vehicle for business purposes. How
Mhm.
is this covered, and should the startup just refund co-founders driving insurance, or does the startup need its own insurance for this?
All right, so let's grab the question up again.
Sorry, it's just sitting there in the chat.
Yeah, gotcha. Look, either or. I mean, we're gonna get the vehicle covered either way, either through the startup or through the individuals. I think it's more of a business decision as who's responsible for it. Very early stage, I know, myself, I'd get my own personal kind of vehicle insurance covered for myself, and same with my co-founder. Now we're a bit more established, so we'll kind of put the insurance through the business. It also depends on what it's used for. So if it's a business use vehicle used for business activities, it's going to be insured differently to a personal use vehicle. And sorry, Dan, I just saw your other one here as well. So cyber threats are investing heavily in fortifying our product. How do we get this recognized to keep our yeah, really good question. Look, that's the kind of role that we play. So we and there's a slide at the very end. Once we understand, what a client's doing to kind of mitigate their exposure, some clients are like, it'll never happen to me. I built the business. I know how it works. We're pretty comfortable. Other clients are like the most risk adverse in the world. They'll do monthly penetration testing. They'll get, third parties to come in and look at everything they're doing. If that's the case, we are the advocate of you and the client. So we go into bat, we negotiate with the insurers and go, hey, these guys are, got multi-factor authentication, they got endpoint kind of testing, they got this in place. It's our job to go in and explain to insurers why, you should be getting a better premium outcome as opposed to someone who isn't. So I think 100% it's a good investment early on. I think if you're getting cyber insurance, now or soon, you're going to be better off because, in a year's time, I think cyber insurance premiums are going to be fivefold what they are at the moment. If you've got it, hopefully you'll just get a rollover premium each year or potentially, a slight increase as opposed to something that's, through the roof due to the losses and the exposures. So highly recommend, fortifying it. Hopefully that answered your question, Dan. Beauty.
Thank you very much.
No, pleasure. And when it comes to cyber, there's two parts of it, which is really important. There's first party and third party cyber. And this again is just that insurance jargon, which gets people a bit caught up. So in essence, one's covering your business and one's covering, people who could be affected by the cyber breach, third parties. So to give you an idea, first party cyber cover, cost to repair or replace damaged data or software, expenses in notifying customers about that breach, which falls under that mandatory notification process, which if you do have a breach, you have to notify the regulatory bodies, the cost of business interruption and lost revenue and expenses relating to it. So good example there. If you're hit by a cyber attack, it's going to cover the damages to your systems, the cause downtime, first party cyber cover, also costs to repairing it. So it'll be technical kind of specialists to get in there, kind of get the data back. It's crazy, like CFC is one of the big kind of cyber insurers based out of London. they have a team, their claims team actually sit there with Bitcoin wallets and kind of dark web chat rooms, and they negotiate directly with these hackers to get data back before it's kind of released. And it's a crazy situation. It's almost like this old school gentleman's agreement where if they give the data back, they get paid for it, and then the data won't be taken away. It's almost like if they do share the data after the ransom being paid, the game's up and no one will ever pay the ransom. So it's you shouldn't negotiate with terrorists kind of thing sometimes, but data's so important to these businesses, and yeah, it's a pretty crazy world we live in. So rundown on first party. Again, third parties, so other people or businesses affected by a cyber incident. So, legal defense costs. So, you've lost some of your customers' data through your platform. It's going to cost, cover the legal defense costs for you to kind of negotiate with their solicitors, settlements, judgments, the costs for fines and penalties. So, yeah, example again, an AgTech startup software fails, leaks customers' data, they suffer a loss. It's going to cover all those costs to get back to where you were, including costs for PR, for reputation harm, and damage to your brand. So definitely a very important cover to have. Management liability. This is an interesting one, sometimes called D&O, but it's more so just standalone D&O when you're a bit more established, or you're pre-IPO or listing. But management liability is almost like a broader version that encapsulates D&O as one of those policies. And this is like, this is when you're starting to seriously think about your business. You've built, you've this baby of yours, and you want to protect it, but also your own personal assets. So this is where you might have raised some capital, and you've got investors who think you've misrepresented them, or you've misappropriated funds, or you have I suppose the timeline of how you're going to roll a product hasn't kind of matched what you told them. This is going to give you a bit of a war chest to defend yourself, to go to court. And sorry, Dan, yeah, D&O is directors and officers insurance. So it's there to protect the personal assets of directors and officers of businesses. So yeah, it's unfair dismissal. It's all those employee kind of practices. So unfair dismissal, bullying, harassment, statutory fines and penalties. So you might have some way of managing something in an agricultural setting, and it's leaked some pollutants into the waterways, and then you've got a massive regulatory fine from government bodies to kind of rectify that. It's going to pretty much give you 1, 2, 5, or 10 million, whatever your limit is, worth of funds to defend through legal advice and fines to pay. So, and I mean, this can start at kind of $1,000 a year. It's not massive, but depending on the size of the business, directors, and the limits you take, it can certainly be built fairly bespokely to you what you do. So yeah, good example here. I find sometimes with insurance, it's good to give an example of how this could play out. But an AgTech startup sued by its investors who alleged the company's directors misrepresented the financial health and growth prospects of the company. The investors claim they were misled into investing more money based on these false representations, resulting in significant financial losses when the company failed to meet its growth targets. Fairly, honest example. This kind of thing does happen, fairly, not that often, but, does happen. How would the policy respond? So you'd be legal defense costs, cover the legal fees for defending the company, its directors. It protects your assets, so you're not selling your house or your cars to, come up with the legal funds to defend it. If a judge does, give you judgments and settlements, it'll pay for those, and any regulatory investigations as well. So yeah, very handy cover to have. We've recently had an unfair dismissal of a CEO for one of our fintech businesses. They went through all the correct processes, all the written warnings. He didn't meet any KPIs. They got rid of him, and then a week later, he defamed the company in the AFR, took them to the federal court for not vesting options that he should have gotten, deleted half the CRM drunk at 3 a.m. Like, it was an absolute nightmare. Our client was paying about $3,000 a year for their management liability. Claim was lodged with us. We advised the insurers. They appointed Collins, Biggers and Paisley, a big legal firm, to go into bat for them. There's about $180,000 worth of legal defense costs and a $90,000 call to bank to make the kind of issue go away. So on the back of a $3,000 insurance policy, it kind of had a almost $250,000 settlement. So yeah, and you just never know with these things. You can do everything right, but there's some crazy people out there. Intellectual property. This is something we kind of don't often see, straight off the bat, unless it's been something that's been in kind of development for a long time. It could be different in the AgTech sector, I guess, but this is an amazing policy we're starting to see, come into fruition a little bit more with. We've got some smart motorcycle helmet manufacturing businesses and some other pretty interesting climate tech, carbon capturing kind of companies, and this goes both ways. So this is people infringing on your IP and the cost to defend it and cease and desist. But also, if you accidentally infringe on someone else's, it's the kind of defense cost there, so that you've got a great policy there to help out with. So it could be copyright, it could be patent infringement, or even IP ownership disputes. If someone else comes out of the woodwork saying that you've infringed on theirs. This is an interesting one. So as businesses grow and scale, satisfying third parties comes into play. So you might have a contract with a big agricultural kind of multinational, and they'll say to you, well, we want to see your $20 million professional indemnity, your $20 million liability, your $20 million cyber, which in essence is going to cost you $250,000 a year. Hopefully the contract's worth well more than that, but we kind of say a lot of the times it's worth pushing back gently and just saying, look, why do we need those limits? Is there a reason that you have it, or is it just standard party view contract? And a lot of clients have a lot of luck in that. They won't be able to justify it, so they'll say, well, the contract's worth $5 million, so take out a $5 million cyber policy or similar. So we do contract reviews for our clients, and we have a legal team that kind of helps with that. A lot of the big mining companies will want hold harmless agreements and to be noted as an insured on the policy, which is usually a bit of a big no-no. And then ASIC as well might want to get some clarification to the adequacy of insurances, which again is something that we're quite familiar with. And the final one, just on the insurance side of things, is kind of workers' compensation. It's something that we don't do a huge amount with. It's kind of the dark arts of kind of insurance. So there's one or two brokers that do it, but they tend to put big fees on. We recommend approaching the kind of local the state bodies. So whether it's work cover in Queensland or iCare down south, it's a pretty easy process of just putting how many staff you've got and what the turnover is and spitting out a premium. Sorry, Dan, just got your question there. Why is noted on insurance policy a no-no? I see this often. Could you give me a bit more background on that one? Sorry, mate.
Yeah, I think a slide ago, you said noted on insurance policy as one of your points there. Yeah, hold harmless agreement and or be noted on the insurance policy. Describe that as a no-no.
Yes.
Yeah, I have done various contracts where the counterparty has required that. So just curious.
Yeah, interesting. It's usually a lot of insurers, like if you have your own insurance policy in place, and for instance, say BHP want to be noted under that policy, they're going to be then an insured on your insurance policy, so they could potentially, lodge claims, on your policy. So we'd kind of push back and say, well, we can note you as an interested party on the policy, but not as an insured. It's almost giving them an insurance policy. And if you're both on a policy and they have claims, you'll then have to declare their claims. You've had claims on a policy that that they've lodged, if that makes sense.
Okay.
So
Thank you.
Yeah, tend to be something. The only one that I've seen is Amazon. Amazon's the only one that kind of, some insurers have got around. Amazon won't accept people selling on Amazon unless Amazon's noted as insured on the policy. But again, yeah, it's for anything out in the field or product based, we'd stay away from.
Yep. Thank you.
Pleasure. So lodging your own kind of workers' compensation through those relevant bodies is going to be much more cost efficient. it's going to cover, for injuries sustained while people are working for you, like during the hours of working. We have seen recently some people want to, cover their employees outside work hours, so to and from work, or one was actually testing that motorcycle helmet. So they'd be doing a lot of night riding and things, which workers' compensation wouldn't cover. So then what comes into play is what's called an accident and sickness or accident and health insurance policy, which can be taken out, giving 24-hour cover, full death capital benefits, and then sickness and illness, so covering the weekly wage for a certain period of time that the client goes ahead with. And then finally, like, this is just kind of a bit of a rundown. I mean, a lot of people think it's just kind of, for us, it's just chucking some information to a computer and getting a quote and then putting a fee on it, and that's our job, kind of thing. But the way we kind of work is we do like a quick intro call with our clients and understand exactly what it is and where you're going and what things are worrying you from an insurance perspective, and then we give an update on how we work. An onboarding call or a jot form or something to get all the information we need to get quotes. And then we'll look through that and go, okay, have you thought about, doing this, this, and this? This is actually going to reduce the opportunity for you guys to have quotes. Have you looked at some penetration testing? Have you updated your legal contract? Different things that, we've seen that can prevent claims. And then we put together, our preparations to insurers. So we put together like a summary and almost like a quotation kind of meeting request with insurers. We go in, we negotiate for quotes, and again, Dan, like you said before, explaining what you've done in risk mitigation for cyber, and it's kind of a one-on-one approach with insurers. So it's not keyboard warriors. It's kind of meetings and negotiations and coming up with the best option we can. Then we'll come up with a bespoke report saying, Dan or Michael, we've been to these 10 insurers and underwriting agencies. 3 declined, 2 provided terms that we thought were favourable. We recommend you go with these guys. They're backed by Lloyd's of London, a reputable company. We can organise a pay by the month option, and they're amazing when it comes to settling claims. Midterm management, so a lot of times you've got changes to policies or organising certificate of currencies, changes and updates of bank accounts. That's pretty much all what we do. And then again, it's just taking that whole the whole insurance piece off your plate. So any claims, you just hand to us, and that's kind of what we do as a broker: manage it, go into bat, and advocate on your process. So it's that's pretty much us in a nutshell, and a fair bit on the insurance landscape for AgTech. So yeah, appreciate you all kind of sticking with me. It's always pretty exciting and in need of a cold shower afterwards, but good to give you guys a run through.
Thanks, Matt. Look, I am mindful of the time. We are a little bit over, but before we sign off, if anybody would like any final questions for Matt or Michael. No, it's not looking. I do have, if everyone could just take a very quick minute to just fill out our poll. There we go, launch that one. Look, thanks guys so much for that. It was a great conversation, and it can be such a dry topic, but I got a lot every time I see people like yourselves present. There is always those little things that you haven't thought about, and I thought those examples were really thoughtful. And a big thanks to Dan for his dynamite questions as well. They were brilliant, particularly deep diving the notations on that insurance. That's not something I had noticed, and probably should in future. So that was great to know. For anybody else on the call, we do have another webinar coming up next month. It's scheduled for the 20th of June, and that will be on building a high-performing team. We will send the details out shortly, and then we'll also be sending out this recording today when it's available this afternoon. But on that note, any closing comments, Matt, Michael, about anything we've seen today?
No, thank you, and feel free to reach out on LinkedIn, or if you need anything, just reach out to me on there, and I'm happy to answer any questions.
Yeah, likewise. Thanks very much for facilitating, Danny. It's good fun.
My absolute pleasure. And with that, we'll close out today. Thanks, everybody, and we'll hopefully see you next time.
Thank you.
Awesome. Cheers, guys.